December 2025. While most people were thinking about holidays and shopping lists, the largest pools of capital on Earth were doing something they almost never do all at once. They were rotating in the same direction, at the same time, with the same body language. And when that happens, you don't treat it as routine rebalancing. You treat it like a weather system changing pressure. You might not see the storm yet, but the air feels different. This is the unseen move of Wall Street. And the warning sign wasn't a headline, it was a flow, a massive, synchronized shift in positioning that most investors shrugged off because it didn't come with panic. It came with professionalism, spreadsheets, and quiet execution. Here's the setup. The world's biggest managers have become so large that when they move, they don't just respond to markets. They shape them. Vanguard, BlackRock, State Street, sovereign funds, pensions. When they rotate, they don't move like retail. They move like tectonic plates. So when you see an estimated $1 trillion shuffle happen in weeks, the question is not, was it normal? The question is, why did it happen now? And why did it happen in a way that screams defensive risk control rather than upside chasing? This is where the title comes in. What Vanguard knows that BlackRock doesn't is not a secret formula or insider tip. It's a mindset difference. Vanguard's DNA is long horizon, valuation first, risk aware, almost stubbornly boring. BlackRock's machine is broader, more product-driven, more exposure-based, deeply connected to the system's plumbing. Both are giants, but they look at the same environment with different instincts. And in late 2025, Vanguard's instinct signaled something that should make you pause. A shift away from the classic 60-40 framework toward a more defensive posture. That's not a casual tweak. I'll say public admission that the old playbook may not protect you the way it used to. Now, layer in the number that everyone hears, but almost nobody feels. The U.S. national debt sitting around $38 trillion and climbing fast. Interest costs now in the range of $1 trillion per year. That's not a talking point. That's a gravity field. It changes what risk-free means. It changes what safe means. It changes what bond yields actually represent when the government must refinance endlessly in a world where rates are no longer near zero. And it changes what the stock market's premium should be when valuations are stretched, volatility is compressed, and the system's cost of capital is quietly rising. So here's what we're going to do in this video. We're going to treat the $1 trillion shuffle as a signal, not a story. We'll decode what the biggest managers were actually doing, why they were doing it, and why calling it portfolio housekeeping is the most dangerous kind of comfort. Then we'll zoom out and compare it to 3 historical patterns where smart money behavior went defensive right before the public realized the floor was not as solid as it looked. And then we'll bring it home to the real warning sign. Wall Street missed the 4.7 trillion sign hiding in plain sight. The scale of passive concentration and duration risk inside the system, where small shifts in yield or confidence can force mechanical selling and create a feedback loop nobody can stop with words. Finally, we'll end with the practical framework. What to watch, what not to overreact to, and how to position your thinking for a world where the old rules may still work until the day they suddenly don't. Disclaimer. Educational analysis only, not financial advice. Now let's start with the simplest question. What did they actually do? The most dangerous thing about a $1 trillion shuffle is how boring it looks to the public. Boring gets ignored. But big money never panics out loud. Big money whispers. And the whisper is always the same sequence. First, reduce risk. Second, increase liquidity. Third, simplify exposure. When you see all 3 happening together, it is not emotion. It is constraint. It means the people inside the system are responding to something structural. Yes, institutions rebalance at year end. Yes, they trim winners and top up laggards. Yes, they bring portfolios back to targets. That part is normal. What is not normal is synchronized behavior at scale. A lot of major pools of capital rotating in the same direction during the same window with the same body language. That usually points to one thing. A shared constraint, not a shared opinion. A shared constraint. The constraint is that markets are no longer offering cheap stability. For years, mega-cap winners grew and grew inside portfolios. They became the engine of performance and the anchor of confidence. But there is a point where size stops being safety and starts being fragility. When the same names dominate most portfolios, diversification becomes an illusion. It turns into a single crowded exit. Here's the simplest way to visualize it. If everyone believes the same thing, the risk is no longer being wrong. The risk is being late. A crowded trade does not fail because the story changes. It fails because the door is not wide enough when everyone decides to move at once. That is what the giants are managing. They are not trying to be heroes. They are trying to be first out of the narrow hallway. This is where the Vanguard versus BlackRock idea matters. Not because one is smart and the other is blind. Both are sophisticated. Both have elite risk teams. But they are built differently. Vanguard has a long horizon DNA, quiet, valuation aware, survival first language. BlackRock is more exposure driven, product expansive, deeply connected to the plumbing of flows. When Vanguard shifts its tone publicly, that is rarely marketing. It is usually a regime statement. It is saying the next decade may not reward the same posture as the last decade. And that is the real signal. Defense is being chosen not because markets are collapsing tomorrow, but because the range of outcomes widened. The tails got fatter, volatility risk got more expensive, correlation risk became more real. When conservative institutions start sacrificing upside to buy stability, you should not dismiss it as housekeeping. You should read it as a warning flare. Here's the paradox. The market can look calm precisely when it is most fragile. Calm is often created by liquidity and confidence, but late cycle calm is often created by suppression mechanisms, passive inflows, volatility targeting, buybacks, and the belief that dips are always temporary. When everyone is conditioned to buy dips, price becomes a story of confidence, not a story of value. That works until it doesn't. And the moment it stops working, the unwind is not gentle because so much of the market is positioned the same way. The warning sign Wall Street missed was that the system has become less resilient because it is more synchronized. That's the real risk of concentration. It's not that big managers exist. It's that big managers behave similarly under the same constraints, and their constraints are increasingly the same. Risk limits, volatility models, regulatory pressure, and the need to protect reputation. When those constraints tighten, everyone sells the same things and buys the same things, and that turns ordinary volatility into a stampede risk. So why did this show up in December 2025? Because December is when reality meets reporting. Performance is crystallized, allocations are reviewed, risk committees meet. Institutions do not want to enter a new year with a portfolio that can blow up on day one of a regime shift. So they front-run uncertainty, they reduce exposure to assets that are priced for perfection and increase exposure to assets that will hold up in a slower, tighter world. That's why the rotation into bonds wasn't just yield hunting. It was a volatility choice. It was an admission that the distribution of outcomes has changed. And here's where history matters. People assume collapse always starts with panic or headlines. It rarely does. It often starts with intelligent money quietly stepping back, not because the end is tomorrow, but because the asymmetry is no longer worth it. That's what makes smart money smart. Not that it predicts exact dates, but that it respects asymmetric risk when it appears. The transcript you shared tries to map this to Rome, Weimar, medieval debasement stories. The core lesson there is not history repeats perfectly. The core lesson is that systems break when promises outrun constraints, and when credibility becomes more expensive to maintain than the benefits it provides. The modern constraint is not silver content in a coin. It's the cost of financing debt and maintaining confidence in the currency while running permanent deficits. Interest costs crossing into the trillion range is not just a budget line. It's a signal that the system is paying an ever larger toll to keep itself running. And when that toll rises, the system has fewer degrees of freedom. That's why institutions get defensive. Not because they love fear, but because they understand constraint math. Now, what does Vanguard know? It knows that when the system becomes constraint-driven, returns become less about innovation narratives and more about capital structure realities. It knows that valuation matters again. It knows that diversification across geography may matter again. It knows that the old idea that US megacap will always be the safest bet can fail if concentration becomes the risk itself. BlackRock, by contrast, is deeply embedded in the plumbing of exposure. It benefits from flows into products and broad risk-on adoption. It can still be cautious, but its machine is optimized for providing exposure, not for telling the public the party is changing tone. Vanguard is structurally more comfortable saying lower your risk because its brand is prudence. So the warning sign is not that Vanguard is right and BlackRock is wrong. The warning sign is that a giant that normally speaks in calm, conservative language is signaling a posture change. And that posture change aligns with what institutions were doing with real money. Now, let's make this concrete. Why would 40-60 ever make sense again when stocks supposedly outperform over time? Because in certain decades, survival beats outperformance. And in certain regimes, bonds can offer return with lower volatility, while equities offer return with higher left tail risk. That is exactly the type of environment you get when valuation is stretched and policy uncertainty is high. And that's why December 2025 mattered. It was the biggest players saying, quietly, we don't need maximum return, we need controlled risk. Now, let's move to the 4.7 trillion warning sign itself, and why it could be the trigger mechanism when the next shock arrives. Think of the market like an airplane. Most of the time, you don't notice the systems that keep it stable. Autopilot, hydraulics, redundancy, control surfaces. They're invisible until something goes wrong. passive concentration, and index mechanics are like the autopilot of modern markets. When money flows in, it buys mechanically, often the largest names in the index, reinforcing leadership and compressing volatility. That creates the illusion of stability, but it also concentrates risk into the same handful of mega-cap exposures, which means the system's center of gravity shifts. If that center of gravity shifts too far, small turbulence produces larger reactions. The 4.7 trillion warning sign is a way to point at the mass of capital that is effectively on autopilot, where decisions are not discretionary but rules-based. Rebalance thresholds, volatility triggers, index weighting changes, risk parity adjustments. When markets are rising, those rules make everything look brilliant. When markets are stressed, those rules can turn into forced selling. And forced selling is how crashes become nonlinear. This is what Wall Street missed. They kept looking for a human catalyst, a narrative event, a headline shock. But the next instability may not be triggered by a headline. It may be triggered by mechanics, a yield spike that forces duration losses, a volatility jump that forces vol-targeting funds to reduce exposure, a drawdown that forces pensions and balanced funds to rebalance out of equities at the worst time, a liquidity event where bids disappear because everyone tries to do the same trade at once. And when that happens, the winners that everyone believed were invincible become the first source of liquidity. That's why institutions were trimming mega-cap winners. That is why the magnificent winners become the sacrificial lambs in a systemic event, because they are the only assets large enough and liquid enough to sell quickly without admitting deeper weakness. This is also why the bond rotation matters. If rates fall during a risk-off event, bonds cushion portfolios. If rates rise because of inflation or supply, bonds can fail at the same time equities fail. That's the nightmare regime, positive correlation between stocks and bonds. A decade ago, people assumed that couldn't last. Today, it can. And if you're a giant institution, you prepare for that possibility by shifting duration, improving liquidity, and reducing concentrated equity exposure. This is not doomsday. This is risk management. But when many giants do it at once, it becomes a signal that risk management is responding to something structural, not emotional. Now, let's talk about the debt and interest piece without drama. When interest costs become enormous, the system is less flexible. Policy choices become narrower. Monetary policy becomes more politically sensitive. Fiscal policy becomes more reactive. Crisis response becomes more expensive. That environment tends to produce more frequent shocks and more violent repricing because the system's shock absorbers are thinner. You can't keep absorbing shocks forever without building stress somewhere else. And where does stress show up? It shows up in currency confidence. It shows up in term premiums. It shows up in the spread between what the market wants and what policy can tolerate. So right now, the warning sign is not that tomorrow is collapse. The warning sign is that the system is shifting from an era where liquidity and confidence were abundant into an era where constraints and trade-offs are dominant. That's what institutions are pricing in. And that's why you saw defensive rotation under the label of routine, because routine is the mask adults wear to avoid causing panic while they quietly prepare. Now, what happens next? If you want a high signal framework, stop asking, will stocks crash, and start asking, where is the next constraint? Is it refinancing? Is it term premiums? Is it inflation persistence? Is it geopolitical supply shocks? Is it regulatory pressure on leverage? That's the game. And in that game, the winner is the one who understands mechanics, not the one who wins the argument online. Now, let's finish with a practical and evergreen framework, how you interpret these signals going forward, and what you watch week to week without falling into fear or fantasy. Here's the evergreen takeaway. If you want to survive regime shifts, you stop treating markets like morality plays and start treating them like systems. Systems behave predictably under stress because constraints force behavior. In late 2025, the behavior was defensive rotation by the largest pools of capital. That doesn't mean doom. It means the distribution of outcomes changed and the giants are repositioning for a wider range of scenarios. So what should you do with this information? First, don't worship the headline. Don't let the phrase trillion-dollar shuffle turn your brain into panic. That's how you get manipulated by your own emotions. Second, do treat institutional behavior as a signal. When conservative institutions reduce equity risk and emphasize bonds or defense, they are telling you that the risk-adjusted return landscape shifted. Third, zoom out to mechanics. Ask yourself, if volatility rises, where does forced selling come from? If yields rise, where does forced selling come from? If correlations rise, what breaks in the classic balanced portfolio? And this is where Vanguard AS posture matters because it asks an early admission that the classic assumptions may not hold as cleanly in the next decade. As for the Vanguard versus BlackRock framing, the real point is that not all giants interpret the same environment the same way. Vanguard's communication tends to be more cautious, more long horizon, more valuation centric. That can become an early warning because it's less motivated by hype. If Vanguard says the decade ahead likely rewards more defense, you don't treat it as gospel. You treat it as an important probability statement from a firm that rarely overreacts. And that's the final key. Probabilities, not certainties. The transcript you provided leans hard into historical collapse narratives. History is useful, but it can also become a theater if we use it to claim exact outcomes. The smarter use is to extract the consistent pattern. When promises outrun constraints, institutions get defensive. When institutions get defensive together, it means constraints are tightening. And when constraints tighten, the market becomes more sensitive to shocks. So what do you watch going forward? You watch the boring signals. Yield curves and term premiums, credit spreads, liquidity conditions, volatility regimes. You watch whether rebalancing continues to sell equities and buy bonds, or whether flows reverse. You watch whether megacap leadership weakens or broadens, because that tells you whether concentration risk is increasing or easing. You watch government financing conditions because debt service is now a macro force, not a footnote. And you watch how the public narrative shifts because narrative always follows price, but positioning happens before narrative. Then you build your mindset around resilience, not prediction. Diversification across assets and geographies makes sense because it reduces the risk that one system AS constraint becomes your entire life, our S outcome. Liquidity matters because liquidity is optionality. Optionality is survival in regime shifts. Time horizon matters because panic is expensive and usually late. And education matters because once you understand mechanics, fear loses its power to control you. That's the real point of this video. Not to scare you, not to sell you a single asset, not to promise a date, but to show you that $1 trillion rotation is not just noise. It is the system speaking in its native language, flow. And when flow changes direction at scale, you pay attention. Because long before the headlines admit anything, capital moves first. If you want, in the next video, we can go even deeper into the exact warning sign metrics that show when a defensive rotation is just routine rebalancing and when it becomes a sustained regime shift, including the specific flow indicators and correlation signals that historically precede bigger dislocations. Subscribe if you want that breakdown, because the most valuable skill in markets isn't predicting the future. It's recognizing when the rules of the game are quietly changing.